Equity markets have been at all-time highs this month, despite debates over the impact of tariffs, a slowing U.S. labor market, and the offsetting tailwind from Fed rate cuts. Now, Citi remains constructive on global equities, saying markets continue to broaden with strong growth in earnings per share across the regions. And let's get more on this from Drew Pettit, the Director of U.S. Equity Strategy at Citi. Drew, thanks very much for joining us today.
Hey, glad to be here, Roger.
What's the main reason for the optimism for you right now?
We're finally seeing growth acceleration here. So it really was just a one-horse race for a while. It was the United States that had growth. And even with tariffs and concerns, the secular growth trends really were pushing earnings higher. When we start looking out to 2026, you're going to see Japan, Europe all contributing, even though they hadn't before. And then sector-wise, you're going to see contribution not just from growth, but from cyclicals and defensives as well across all the regions. So the broadening, it's not just a U.S. story. It's not just a Europe story. It's now spread to APAC. It's a global story and a global sector story.
And is that people just looking for deals elsewhere? It's hard to find anything in the U.S. right now?
No, honestly, there's no real deals in any good growth story globally. We're finally getting the earnings tailwind to justify where the valuations are. You know, the U.S. we always talk about is a bubble building. We don't think we're there yet. But when we look globally, valuations versus their history aren't cheap either. Are they relatively cheap to the U.S. in absolute terms? Yes. So it's not about deals. It's about fundamentals to drive prices higher. It's all about earnings from here.
And what do you want to see when it comes to earnings? What gets you interested?
So it's finally seeing these downward revisions for 2025 and 2026 ending. That's been huge. Coming out of the Liberation Day lows, where a lot of tariff impacts were getting worked into numbers, we just saw estimates just consistently fall for all the different regions. Now we're on the other side of that. We're finally seeing currency stabilization, which matters a lot for international companies. We're seeing macros outside of the U.S. start to stabilize as well and work off of more recessionary or kind of soft recessionary levels. That's all really important. So revisions moving higher to really confirm that we're going to get earnings acceleration is what we want to see.
And just talking about the U.S. for a second, you are expecting another double-digit growth this year, or coming up in 2026.
Yeah, and for once, it's not just the Mag 7. We can talk about other sectors contributing. Look, financials have been on a really good run with earnings. Our analysts have highlighted some good early results there, even though the price action has been a little bit messy. But you're finally going to see earnings growth inflect for consumer, which has been under pressure. You're going to see it continue to be strong for financials. Even energy off of low starting numbers is going to be a positive contributor. So next year, that, let's call it 12, 13, potentially 14% earnings growth is not just the Mag 7 growing and a whole bunch of companies pulling the rest of the index back. It's going to be a group effort to push earnings higher.
And how important is that to you to see it spread around a little bit for you?
That is massive at this point because it's hard to get narrow markets to push much higher without inflating some bubbles. I think when we have breadth and more opportunities, it's going to take the pressure off growth to be the only engine within the U.S. markets. So when we can find more opportunities, you can see some healthy profit taking near term, and then that money being put back to work into more growth stories. It even brings small cap into the discussion, which has really been kind of blah for the last couple of years. So to us, massively important to get broadening of earnings if we want another leg higher in this bull market.
And now, we're going back to the Europe and overseas. You're overweight in continental Europe and overseas. Is there an area you're focusing on, or is it everything is kind of looking good? We were talking about it a little earlier.
So it's funny. Yes, those are our weights. It's kind of a way to balance cyclicals with growth. EM gives you some really good growth in AI stories. Continental Europe gives you more of a cyclical feel when you think about the indices. But the big story actually hasn't been regions. If you look at the past 2 quarters, the difference between the best performing region and the worst performing region's been very narrow. There hasn't been much dispersion. The real story is what you do at the sector level. And to us, it's almost everything but defensives. We can buy cyclicals. We like financials for that. And you can buy growth, so specifically tech.
Do we know why it's been so evenly spread? Any indicators for that?
It's the revisions. It's back to earnings. It's funny. We talk so much about valuations when you hear different commentators on TV, but it's earnings that end up being the real long-term driver of equity markets. And now that you have more earnings contribution and positive earnings at that, you end up seeing less dispersion between the indices. So again, as growth narrows, so should performance differentiation as well.
And talking about earnings, it is earnings seasons. Any indicators that right now it's shaping up to be a pretty good one? Any indicators that it might flatten out a little bit, or what would be some concerns for you?
So the concern is we've priced in a lot of good news. Look, it's kind of been our view that, yeah, valuations are stretched. We said that earlier in this interview even. The concern is if some of the structural stories, if the tone around those changes. That's a longer term concern. Structurally, we're really positive on productivity, margin enhancement, secular growth stories. Near term, we do think management's being a little bit more cautious after stocks have run and trying to, let's say, lower the bar for 2026 estimates could lead to some profit taking, but we think that's completely healthy. You should expect near-term volatility. You should buy into that weakness because the structural growth story is still ahead.
Okay. Drew, thank you very much for joining us today. Have a great weekend.
Hey, you as well. Thank you.
That was Drew Pettit, Director of U.S. Equity Strategy at Citi.